All right, hello, welcome to Chapter 15b in Finance 301. This is Part A of Chapter 15b. Let's jump right in. What we're going to learn in this chapter is about what's called the weighted average cost of capital and how to value an entity for a debt equity team. So let's get moving. All right. So in Part 1, we're going to be thinking about valuing a perpetuity entity for a debt equity team. A perpetuity entity is exactly what it was in Chapter 15a. It's an entity that is operating in steady state forever. So remember, when we were valuing an entity for owners in a perpetuity scenario, the situation was we had this firm operating in steady state forever, and the prospective buyers, if they went ahead and bought the firm, they would own it forever, and they would enjoy its cash flow dividends forever. So our NPV formulation had two pieces: the price paid for the firm at t equals 0, and then the present value of all the free cash flow dividends going out until hell freezes over. And then I'd like to cast this now in this chapter in terms of equity values. So when we did this, formulated this NPV setup for this type of firm, we had two equity values. The price paid is always the market's view of the equity value. Equity value meaning what the firm is worth to its owners. And the other piece of our NPV equation, the free cash flows discounted back to t equals 0, are the equity team's estimate of the equity value. So the NPV, we could think of the NPV like this: the equity team's estimate of the equity value versus Mr. Market's view of the equity value. So we subtract Mr. Market's view of the equity value from the equity team's estimate, and that's our NPV. Now we want to do something similar for a perpetuity entity to a debt and equity team. So here's the basic idea. So we've got a debt equity team that comes along to take full financial control of a firm. What does that mean? It's going to buy all the shares of the stock, and it's also going to pay off all the existing debt and make new bonds or loans to the firm. This is called refinancing the firm's debt. So you might want to know, why would we want to do this, and why would shareholders care about this? Well, there are two big reasons. The first one is sometimes we have no choice in a situation where we say there's a change of control put. So what usually happens with bonds and loans is that the lender, who would be the bondholders or the bank, puts into the contracts that if there's a change of control, then all of the debt becomes due and payable right away. And the reason for that is, let's say that you were running a fantastic business and you had $1 million loan outstanding with JPMorgan Chase. And all of a sudden I come along and I want to buy that business from you. So you and I come to an agreement. I'm going to pay to buy from you 100% of the shares. And I think that's the end of it. But it's not, because JPMorgan, because that contract has a say in this. JPMorgan says, well, you were doing a great job running the company, and we know you and we trust you. This Webster guy's got a bad reputation. He might do something fraudulent. We don't want to loan to him. So if he's going to be owning the company, we don't want to have anything to do with it. So if you're going to sell to him, all of the debt is due and payable at the time of the sale. So what I would have to do in that case is I'd have to buy all the shares from you, but I'd also have to refinance the debt. I'd have to find another lender that would be okay lending to the company if I'm the owner of the company. So that's case number one. That's the change of control put case. And reason number two is that, as we learned in Chapter 6, it may be better for the owners and for the lenders, for that matter, to change the ratio of debt to capitalization for the firm. Remember, we found out in general, if we lever the firm up with some debt, the ROE for owners increases. But if we do it too much, then we have too high risk of bankruptcy. So if we are coming in to take over a company, we may believe that the current owners don't have an optimal capital structure. They don't have an optimal weight of debt to equity in terms of maximizing shareholder value via ROE and keeping the risk of bankruptcy at bay. So that would be the second reason, because we'd want to change the relative amounts of debt and equity when we came in. All right, so what's our NPV formulation going to be for a debt plus equity team? In this case, we're going to be working with a steady state firm, take full control, own it forever, operate it forever, and enjoy the firm's free cash flow dividends forever. So the formulation, the NPV formulation for this project, is very, very similar to what it was previously when we were valuing just for shareholders. The only difference here now is that we've got, instead of E down here and here, And here I have D plus E, meaning that we've got to consider the price paid to take full control of the firm by the debt team and the equity team, right? So that is what the team is going to have to pay to buy all the shares of stock and restructure the debt, buy in all the current debt, and then issue new debt. And the free cash flows now are going to be free cash flows available to the team, to the lenders, as well as the shareholders. And the cost of capital is going to be what we call a weighted average cost of capital, which is appropriate to use when we have a debt equity team taking over and managing a firm. So let's think of this the same way that we thought of the formulation for shareholders only in terms of equity value. Let's do the same thing now for the debt equity team. And the analog here is thinking about this in terms of enterprise value. Okay, so in this case, the price paid by the whole team to take full control of the firm is called the enterprise value. The price paid by just the shareholders, we saw a few slides ago, to just get 100% of the shares of the firm was called equity value. And that down here next, the present value of all the cash flows that the team is going to enjoy from controlling the firm is the team's estimate of the enterprise value. And that's analog to what we had with shareholders for the team's estimate of equity value. So these are completely analogous to what we had with shareholders, but instead of saying market's view of equity value, we say market's view of enterprise value. And instead of saying our best estimate of equity value, we say our best estimate, the team's best estimate of enterprise value. So again, we can say here the NPV formulation is really our view of the team's view of the enterprise value minus Mr. Market's view. And we want that to be positive. We want our view of what this firm is worth to the team to be greater than the market price, which is Mr. Market's view. All right, so we got a note down here for the finance majors. I'll leave it to them to read that. It's an alternate formulation of the team's estimate for enterprise value. The rest of us mere mortals, as usual, can skip that. But what I'd like to do now is find the appropriate cost of capital for the team and also the free cash flows to the team. So let's see if we can do that. Let's start with the cost of capital. So it turns out, which is the subject of master's level MBA books, so we won't worry about how, but it turns out the truth, the whole truth, and nothing but the truth is that the appropriate opportunity cost of capital for the whole team taking control of an entity is called the weighted average cost of capital. And that's called R sub WACC, and it's also called by many people WACC. But as always, it's just an interest rate or a discount rate. So how do we compute the weighted average cost of capital? Well, it's 1 minus the tax rate times RD, and the RD that we're talking about here is pre-tax. Whoops. So that's going to be our post-tax cost of capital when we multiply it by 1 minus the tax rate. And that's going to get multiplied by WD, which is the weight of debt the firm is going to have after it's purchased. And then we add to that the cost of equity capital times the weight of the equity that the firm will have after it's purchased. So the RWAC is truly a weighted average cost of capital, considering after-tax debt cost of capital and after-tax, of course, equity cost of capital. So that's our appropriate opportunity cost of capital for a D and E team. All right, so what are all these terms? So RD, again, is that pre-tax cost of debt financing, and the tax rate is, as usual, how much tax is being paid in percent, and 1 minus the tax rate is the tax shield effect, and that's going to have a benefit. That always has a benefit, and we'll see how that works. RE, we know, cost of equity financing. And how do we get the weights here? So the WD is our weight of debt financing, and the way that we get that is we take the total debt and we divide that by, the total debt plus equity. So that's our weight of debt. And we also are going to start calling this for short D over D plus E. So where do we get these numbers? From the balance sheet. So that's our weight of debt, okay? And D just comes right off the latest balance sheet. And E is the estimated market value of the equity, which actually, I misspoke a second ago, will not come typically from the balance sheet. It might come from the balance sheet when the market value of equity is the same as what's on the balance sheet. Okay, and also when the market value is unavailable, if we have a privately held company, in that case, we can use equity from the balance sheet as well. So with that said, weight of equity is going to be total equity divided by debt plus equity right here. Okay. All right, so those are the key terms of the weighted average cost of capital, important thing to note, the weight of debt plus the weight of equity always adds up to 100%. And like I said, the WACC is always really just a weighted average of post-tax RD and RE. So let's look at a comparison of opportunity costs of capital for valuing an entity for shareholders versus valuing it for a whole debt equity team. Okay, so when we're estimating NPV for owners, we just use the equity cost of capital from CAPM or the opportunity investment method or something like that. And when we're evaluating NPV to the team, we use that weighted average cost of capital. So it's going to be important for you to remember which to use in which circumstances. If we're valuing to shareholders, use RE. If we're valuing to a debt equity team, use the weighted average cost of capital. All right, so let's do an example to compute the weighted average cost of capital for Zero Motorcycles. So Zero Motorcycles, aka the Tesla of electric motorcycles, just reported a balance sheet and an income statement. And so we have the usual kind of stuff, current assets. They got a lot of PPP, they're a manufacturer. They've got some short-term debt, other current liabilities, long-term debt, and they have some equity. So whatever, that's all fine. And pretty small company, revenue of 50 million and net income of 15 million. That's 30% profit margin. That's pretty great for an industrial company. All right, so let's see what these notes say. So our first note here is on our short-term debt. Okay, so the debt balances have been constant for the past year. So that means that the BOP debt is going to be the same as what's reported on this latest balance sheet. Okay, and let's see that in this case, the equity market value is very similar to the equity gap. So we'll be able to, without any problem, use that 25 million as equity in computing our weighted average cost of capital. And the firm estimates, happily someone's done this for us, that its equity cost of capital is 20%. All right, so let's see if we can put together our weighted average cost of capital for the firm. This is what we're looking at here. So let's start with RD. So we know that the pre-tax cost of debt financing is just total interest paid divided by debt at beginning of period. So let's go back and see what we had. So for our interest, we have 10 million, and we want now the total debt. So we gotta look here, and we want the short-term debt plus the long-term debt. So I think 25 and 50 is 75 in most circles. So we're gonna have 10 over 75. So let's go ahead and do that. So we've got 10 divided by 25 plus 50, okay, and that's equal to 13.3333%. Okay, so let's double check on that. Okay, looking good. And the income tax rate here, we have to remember how to get our income tax rate. That's equal to our tax divided by our EBT. That's something you need to remember from chapter 6. You'll need to know that on exam 3. And so let's see what we have here. So tax is 5. So EBT is equal to 50 minus 20 minus 10. And that's equal to 50 minus 30 is 20 in most circles. So we're going to have 5 over 20 here. So let's go ahead and put that in. 5 over 20. And I think that is 25% because 5 times 4 is 20. I can even remember that. Okay, 0.25. All right, so we're given the estimated cost of equity financing. Okay, so the weight of debt financing, so that's going to be D over D plus E. Okay, and we said the total debt was 75, and we've got that up above here. And let's see what the equity is, because of course I've forgotten. Okay, and the total equity is 25, so 75 plus 25 is 100. So let's put in 75 plus 25. And if we work that out, 75 over 100 is 75%, 0.75. So that's looking good. Okay, the weight of equity financing is E over D plus E. But remember, they have to add up to 100%. So I'm just going to say 0.25 because the debt financing and the equity financing weights have to add up to 100%. So now we're ready to get our weighted average cost of capital. So I'm going to say we have 1 minus our tax rate, which is 25%, times, what's our RD? 13.33%, times the weight of the debt here, and that is 75%, plus the cost of equity capital, which is 0.2 times the weight of the equity financing, which is 25%. So I'm going to stop using percent now and hopefully not confuse you all too much. Okay, and let's see what that is equal to. So let's just go here. And let's put this into our electric pencil. Okay, and we got 12.5%. So it's really that straightforward. So you do need to be able to do a calculation like this on exam 3 to compute a company's weighted average cost of capital. All right, next up, let's get our appropriate free cash flows for all stakeholders. So these are the free cash flows to the debt and equity team. So let's start with the free cash flows that we had for shareholders only and just tweak that a little bit. Okay, so same as with looking to just shareholders, let's use our simple accounting assumptions. And let's start with the general case free cash flow equation for shareholders. So all we have to do to go from shareholders to the team is make two modifications. The first one is we want to replace net income with EBIT minus tax on EBIT, which is, through the awesome power of algebra, EBIT times 1 minus the tax rate. And the reason that we want to do that is we want to replace cash and accruals to owners with cash and accruals to both lenders and owners. So we got to go higher up in the cash chain to get that. Okay, and the second thing that we've got to do is remove that delta debt term altogether because we want cash flows to both the debt team and the equity team. So we don't want to include those changes in debt. So once we've made those two changes, yahoo, here we are. Okay, the free cash flows in general available to the team, to the lenders and the shareholders, are equal to 1 minus the tax rate times EBIT plus ... everything else we had before except the debt term. All right, a couple notes on this. This is an important one, so I'm going to put here no this. Okay. EBIT times 1 minus the tax rate is called by many people NOPAT, which stands for net operating profit after tax. So you need to know both terms. You need to know EBIT times 1 minus the tax rate. You need to know that's equal to NOPAT. So we can write the same equation in terms of NOPAT means the same thing. Sometimes people will do that. So we could write it either with the NOPAT term or with the EBIT times 1 minus the tax rate term. Okay. And now, important thing, which should make everybody so happy here. Second thing we want to note is, just as was the case when we were valuing to shareholders only, we're just going to consider steady state firms. So with steady state firms, everything drops out of this equation except for our NOPAT, or our EBIT times 1 minus the tax rate. Because first of all, the free cash flows, if it's steady state, are going to be constant in any given year. And secondly, as we worked through with the shareholder situation, all the other terms in this equation drop out, because if the firm's in steady state, depreciation is going to be exactly equal to CapEx. And if it's in steady state, there's no changes in the balance sheet, so no changes in working capital. So that is very, very nice thing for us, which is going to make our life very, very simple. So for you finance majors out there, you are going to jump into in your next course considering firms that aren't in steady state, and then boy, do you have an accounting nightmare on your hands. But the rest of us don't have to worry about that. Okay, so there's an example coming up next year, and I'd like to do this example with you. So max value is back in action, and we want to know if max value and its lending partner, if they team up, should they take full control of Workclose Inc. So Workclose Inc. is going to be a little bit different than it was in the previous chapter. So max value is the same, but now they've got a lending partner. And situation for Workclose, same basic operations that they had before, same steady, stable business, same well-managed firm. And now it's being sold for $100 million. Okay. And we'll see what's going on with that. Right now, the debt of the firm is 0. So this here, this 100 million is going to be by just the shares of stock, because company has no debt. If the company had some debt, we'd have had some bonds outstanding. The team, the lending team, would have to pay off all the bonds and make new loans to the company. But we don't have to worry about here because the company right now has no debt. Okay, company's tax rate is 40%. The debt, like we say there, is 0. Here's their most recent income statement, 88 million. And for their revenue, and we work our way down, and their net income is 10.8 million. And again, that's steady state. So that was last year, that's this year, that's the next year, that's the next year, et cetera, et cetera. All right, so is this purchase refinance a positive NPV project? Let's go through the assumptions. So once again, max value believes it can't improve the operations. It will be steady state, so that's great, makes things very simple there. But now we have a complication. So this is not a stupid team here. This is a smart team here, and they know that the optimum capital structure is almost never to have no debt. So the team has figured out that an optimum capital structure for WorkClose Inc. would be a weight of debt of 20%. So they're going to make that happen by having the company take out a loan at t equals 0. Whoops, oh no, I lost my little microphone there. And so the company will have some debt, and the share count, the number of shares outstanding, will go down, et cetera, et cetera. Let's see specifically. Okay, so if the team does this, it's going to fund the purchase using 80 million of max value's own cash. That's called E for equity. And the other 20 million is going to come from a loan provided by the lending team. We'll call that D. And the interest rate on that loan is going to be 7.25%. Okay. And how does this work? The loan is going to be taken out by WorkClose Inc. at the moment of closing of this transaction. So now WorkClose Inc. is going to have 20% less shares outstanding, 20% less equity, and it's going to have some debt. And again, remember, we learned in Chapter 6, this is called a leveraged buyout, and it includes the refinancing of the firm by restructuring its debt equity balance. All right, let's see some other things we'll need to know here. Of course, as interns going into this firm for our first day, so we're told the risk-free rate at the current time, we're told the stock market return rate, and we know that after the firm is bought by us and it has some debt, the interest rate, the pre-tax cost of debt capital, will be 7.25%. And we know that the equity cost of capital, thankfully someone else has figured that out for us, is going to be 12.33%. In this case, there's a bit of terminology we really need to know. In this case, we say we have a post-purchase capitalization of 100 million, which is equal to the debt portion plus the equity portion. So the debt portion is 20 and the equity portion is 80. So we call that the total capitalization. And that's also what? That's the market's estimate of the firm's enterprise value. All right, so here we are on our first day of our internship, and we've been given all that information. And now we're asked to find, first of all, what's the appropriate weighted average cost of capital to use in this case, and to find the free cash flow that can be thrown out by this steady state firm every year without screwing up its operations. And that's going to be now a free cash flow to the whole team, not just to the shareholders. And let's find the present value of these future cash flows. And that is completely a mistake. Who wrote that? Okay, that is the team's estimate. The team's estimate of enterprise value. Team's estimate of enterprise value or equity value is always the present value of what we're going to get if we own the firm. And the market's estimate of equity value or enterprise value is always what we pay at t equals 0. Okay, all right. And so now our last step is going to do an NPV evaluation of the firm, taking what we think the enterprise value is worth, subtracting what we'd have to pay for that, and hopefully that's going to be a positive number. If not, no big deal. We just say we should not do this deal. All right, so let's go ahead and do this. So first of all, let's compute our weighted average cost of capital for the post-purchase capitalization. So just reminding you of some of the key things that we need here to compute our WACC. So let's remember what the WACC is. It's 1 minus the tax rate times the RD times the weight of debt plus RE times the weight of equity. Okay, so remember we said, you can go back and check me. I remember at this time the tax rate was 40% for this firm. So we're going to have 1 minus 40%. And what's going on here? Typing hell, 1 minus 40%. There we go. Times, okay, our pre-tax cost of debt capital is just the interest rate that's being charged by the lending portion of the team. So that's 7.25%. And that's going to be times, what is our WD? It's D over D plus E, and that's WD. So let's put that in. Okay, 20%. And we need plus. Now the equity cost of capital is computed by someone else, 12.33%. times the weight of equity. If the weight of debt is 20, the weight of equity has got to be 80 because they got to add up to 100%. But you could do the calculation to convince yourself if you want to. So let's put in 80%, and let's throw this into our electric pencil and see what we get. And we get 10.73%. All right, on the next page, I've got a little comparison of existing versus as purchased here and some of the key quantities. So we're going to be working our way down to weighted average cost of capital. So I've got two columns here. The existing column with no debt, D equal 0. That's the way the firm exists right now before it's purchased. And then after it's purchased, it's going to have debt of 20 million. Okay, so the weight of debt is going to go from 0 to 20%. And the cost of debt capital goes from 6.75% to 7.25%. The reason for that is that, they have no debt here, but let's put a little star there. So this would be, let me put a star here too. So that 6.75, it seems weird to just say, well, if they have no debt, what would their cost of capital be for that debt? And the way you think about this is if a company has no debt and they took out, say, a $25,000 loan, which would be a tiny loan for them, that would be the interest rate they'd be charged. But as we know, the more leverage you have, the more risk of bankruptcy. So this makes sense, right? That as the company levers up and has more debt, the interest rate that it has to pay is going to increase. That intuitively makes sense, and it's absolutely true in the real world. Okay, I'm not going to worry so much about beta. Let's just skip that. And let's go to RE. So notice how the equity cost of capital has moved up too. And that's for the same reason that the pre-tax cost of debt capital goes up. The more leverage a firm has, the more debt it has outstanding, the riskier it is, the more risk there is of bankruptcy. And that's bad for lenders and it's bad for shareholders. So that makes sense too. And now let's go to the weighted average cost of capital. Well, clearly, if there is no debt, the weighted average cost of capital has got to be the equity cost of capital because all the other terms drop out. But now look at this. It's come down here, the weighted average cost of capital. So did we make a mistake? I don't think we made a mistake. And let's think about this a little bit here. So the weighted average cost of capital has gone down. Does this make sense? And I'm going to say yes, because of the tax shield. Okay, and let's go back to this part right here. This 1 minus the tax rate is what? It's a number less than 1. So it's driving down the whole total weighted average cost of capital. So this is another nice benefit we see of the tax shield. Okay, and again, just to summarize, RD and RD do increase, and that makes sense too. That's, yes, increased probability of bankruptcy. Woohoo! All right. Okay, so next we've got to get our free cash flow to the team. But remember now it's steady state entity, so it's just going to be NOPAT or EBIT times 1 minus the tax rate. So let's see how this works on an income statement. Remember, NOPAT was defined to be EBIT minus tax on EBIT. So we should be able to find this directly by just mucking around a little bit with an income statement. So here's an income statement. And again, I have two columns. I have for existing and as purchased. And I've got my depreciation, blah, blah, blah. I've got my EBIT. In both cases, EBIT is the same because it's before interest and tax. And now here I have, what's this? In this column here, that's tax on EBIT. So there's my NOPAT, which is EBIT minus tax on EBIT. So it's 10.8. And then again, for you accounting folks, you do your indirect cash flow statement thing, and you see for this steady state firm that the NOPAT is actually equal to the free cash flow total. Okay, so let's see, we could also get that free cash flow by 1 minus the tax rate times EBIT. So we'd have 1 minus 40 per, whoops, let's 1 minus 40% times our EBIT was 18 here. And let's see what we get for that. Okay, we got the same thing, 10.8. And again, our tax rate was given up above at 40%. And you could also do that from the existing column. You could compute that if you wanted to. That the tax rate is the tax over EBT. So that would be 7.2 divided by, let's use this existing one because then EBIT is also equal to EBT, and that's 18. And let's see what we get here. Equals 7.2 divided by 18. And again, that's 40%. But that was given in this case. All right. So last step here is we've got all the data we need. Let's put together our NPV for this project and see what it looks like. Okay, so the team would have to put in 100 million total to take over the firm. Plus, we know the free cash flow is 10.8, and that's divided by the cost of capital weighted average was 10.73%, I think. Let's go back and check our WACC because I don't remember exactly. So let's see, 10.73%. Okay. All right. And let's see what we get for our NPV. And we get 650,000, which is pretty good. Let's just say 0.65. So the NPV of this project, remember that's hundreds of thousands, so that's pretty good. So we've got NPV D plus E is greater than 0. So this is saying that this is a good project for the team. So we would go back to our managing director and say, based on all of your assumptions and all these models, it's an NPV positive project. And that's it. So what's coming up next is valuing a buy, manage, sell entity project for a debt equity team. And we'll leave that till next time. So till then, stay well and see you soon.